Good morning, everyone. I am Bernard Yang of ABFER. And together with my co-organizer, Professor Zhiguo and my collaborators from the SAIF, the PBC School of Finance, UHK Shenzhen and Hong Kong, I would like to welcome you all to the third e-seminar of Capital Market Development, China and Asia. Efficient allocation of resources critically depend on a good capital market, and a good efficient capital market depends on really efficient and informed pricing in equity, in bonds, etc., etc. Today we have a very important topic: the SOE premium and government support in China's credit market. I would like to introduce our presenter today, Professor Jun Pang, who is currently a professor of finance and SAIF chair professor at Shanghai Advanced Institute of Finance, Shanghai Jiao Tong University. Prior to joining SAIF in 2019, Professor Peng was at the School of Management, was at MIT Sloan as the School of Management Distinguished Professor of Finance and Professor of Finance. Professor Peng has a BS degree in physics from Shanghai Jiao Tong and a PhD in physics from NYU, and also a PhD in finance from Stanford University. Our discussion today will be Professor Zhiguo from Chicago booth. Our order is that Professor Peng Jun will speak for about 30 to 40 minutes, and then Professor Zhiguo, the discussion will have about 10 to 15 minutes, and then we'll have Q&A. And typically, we habitually really almost run over time, but for people who need to leave as sharp at 12, please feel free to do so. And Professor Peng Jun, the floor is yours. We look forward to learning from you. Thank you very much.
Thanks, Bernie. Let me share my screen first. Okay, thank you very much for this opportunity to present. So the motivation of, first of all, the paper is joined with Zheuck from SAIF. He is a PhD candidate at Shanghai Jiao Tong University, SAIF. And he is going to be on the job market later this year, early next year. So all schools should take a close look at Zheuck. So today's topic is very much within the theme of this seminar series, is to understand or study China's capital markets. So for this paper, we have a very unique focus that is on the SOE, the presence of state-owned enterprise, the SOE premium, and the presence of government support for these state-owned enterprises in China's credit market. So let me start. So as I said, our unique focus here is on the China's credit allocation with respect to state-owned enterprise. We all know that in China, the presence of SOE is a very important feature in China, and the tension between SOE and the POE is something we consistently discuss in China. The topic is important because the allocation efficiency or inefficiency has an impact on the aggregate growth of the economy. In particular, in an important seminal paper by Shea and Kleinov, they show that allocation inefficiency could have a drag on the aggregate growth. So what we focus on, what we would like to contribute to this very important literature is that the existing empirical evidence on credit allocation in China is, in a way, rather limited. For what we see is mostly anecdotal evidence on the SOE's preferential access to bank loans. That's been widely cited. But if you think about the empirical evidence, especially on the loan pricing, how much does the SOE preferential access in loan pricing is very much limited in terms of the empirical evidence. And this is very much because of the the limitation of the loan data. And also that preferential access or the SOE premium, it's also time varying because different economic conditions, different government policy also influence, have an influence on that divide between SOE and the non-SOE. For example, Nick Bladi's work very much informed us of that time variation. His first book on that topic was Markets Over Mall, which means that, which kind of document the retreat of the SOE and advance of the private sector. And then his second book was The State Strikes Back, which basically document the reversal of that trend, which is the advance of the states and the retreat of the private sector. In a way, 国进民退, that four-letter word in China is very much used in discussion of that phenomenon. So, and moreover, when you look at that tension between SOE and POE, it's not only in the sector of bank loans, because financing, credit financing is very much interconnected. So you have a connection between bank loans, credit market, and the shadow banking. So whatever the government policy will, for example, if the government decides to clean up the shadow banking sector, it will have an unintended consequence on all the rest of the sector. So there is an interconnectedness among these different channels of credit financing. So what we are focusing on in this paper is to offer empirical evidence, mostly empirical evidence on this very important phenomenon in China. And our focus is on the credit market. Because it's the most visible slice of the credit financing, it also gives you a huge amount of data for us to work on. So what are we able to document in this paper? First, we basically, very simple, we documented the SOE premium. So we quantify the segmentation between SOE and the non-SOE in the credit market pricing. How big is that premium? Or how much preferential access, how much preferential treatment does the SOE enjoy in the capital market? And we also document the time variation of that SOE premium. So it's not a constant. There is a very significant time variation, as you will see later in the paper. Also, by focusing on the credit market, we actually can look at these companies, not only their credit market access, we can also look at their other aspects. For example, we can use government holdings of these companies to get a sense of how much government support is really there for these companies. And as a result, we actually use these issuer level measures of government support to explain. We find that these measures actually can explain the SOE premium. And moreover, after documenting this segmentation in credit pricing, we also want to look at the price discovery function in China's credit market. We find that price discovery actually shifts or moves under this credit market segmentation. And finally, probably the most important observation is that this credit market allocation or misallocation, depending on how you see it, actually has an impact, has a real impact. In particular, the non-SOEs versus SOEs, their efficiency changes with that credit market allocation or misallocation. So this is kind of the main motivation of our paper, and also what we are able to offer in this paper. The reason why we are able to write this paper is because of this tremendous growth in China's onshore credit market. So this is very much part of the theme of this seminar series. China's credit market, all China's capital markets are growing. So some very raw numbers. By 2020, the total amount of credit market is about 20 trillion RMB. It's second only to the US. The global share of this market is about 3% back in 2008. So if you think about in 2008, this is the overall size. By the way, the blue line capture the overall size of the China's credit market for non-financial firms. And as you can see, in the total amount of outstanding by 2020, it's about 24 trillion. By contrast, at 2008, it was really a tiny amount. So by 2008, it was about 3% of the overall global share, but by 2019, it was already a quarter of the global share. And this picture further shows on the left axis the fraction of the different components of the credit instruments. So the focus of our paper is that blue bars. These are corporate bonds issued to non-financial firms in China. So if you look at a picture like this, or the growth, the blue line, how it grows in terms of a growing market, cannot help but think that if you think about the past 3 decades, gives you the rapid growth of China's economy, then in the coming decades, the global integration or the maturation of China's markets will be a very interesting component for us to study. And this is what our paper is motivated by. Another aspect, as I mentioned earlier, is that debt financing in China is not an isolated, just a credit market. There are 3 major components. So the blue bars, these are the bank loans, and the green bars are the shadow banking, and the red bars are the bonds. And the overall size in trillion of RMB are marked on the left. And what's interesting is that the red line here gives you a sense of, in terms of importance in this economy, bond extension of credit through bond market versus bank loans. You can see China, it remains to be the financial sector in China remains to be a bank-dominated financial system. Nevertheless, you can see the bond markets are actually growing. So for non-financial firms, the importance of their bond, you think about the bond to loan ratio, it's about 20% in recent time versus in 2018, that was roughly about 10%, or less than the excess on the right, less than 4%. And also, absent of pricing data on bank loans and shadow banking, because these are more opaque, our paper uses the more transparent credit market to uncover the otherwise more opaque credit allocation in China. So these are the motivation. So what do we find? There are 2 dates are really important for us. First is 2014, the first quarter of 2014. That's when the first default ever happens in the China's corporate bond market. So what we find in our paper is that post 2014, after the first default, credit quality becomes an important component in credit pricing. Prior to that, interestingly, credit quality, we later I'll be more specific about how we measure credit quality. Prior to that, after controlling for credit rating, measures of credit quality was actually not important in credit pricing. Another interesting important date in our study is 2018 Q2. That's when the new regulations on asset management took place. So it's kind of a sequence of government-led credit tightening in the credit market. So 2018 Q2, you can think about as the peak of that credit tightening. And we find that post that date, the extent of government support beyond the label itself, you know that in China, companies either SOEs, non-SOEs. But we find that post that date, the actual extent of the government support becomes important in credit pricing, going beyond the label. So by 2018, label itself is not as important as the actual measure of government support. So these two measures will be important later in my talk. We use Merton's model to create the credit quality measure. And we, as I said, we use the government's holdings of these companies' equity to measure the extent of government support. So in addition to that two important dates, we also looked at the segmentation, as I said, the segmentation and pricing between SOE and the non-SOEs. We find that post that date, as I said, this is an important date of the peak of the government-led credit tightening. The SOE premium exploded from a normal 20 basis point to well over 100 basis point. So that explosion actually happens within just 1 quarter. And moreover, we explain this SOE premium using the issuer level measures of government support. In terms of asset pricing, we look at the price discovery under this segmentation. We find that non-SOE credit spreads actually become more kind of specialized on credit quality, while the SOE credit spreads, the SOE bonds become more sensitive to government support. So it's kind of a segmentation in the content of that price discovery as well. Finally, we find that post 2018, because of this allocation inefficiency, non-SOEs are losing their advantage over SOEs in their profitability. So these are a summary of our main findings. How does our paper relate to the existing literature? There are 3 areas of existing literature we kind of contribute to. First is the macro literature, which looks at the credit misallocation and their impact on China's growth. In fact, Michael, who is on the panel here, Michael Song, also has a very important paper on this topic. So our paper contributes to this literature by basically, because most of the evidence in this literature is on bank loans. So what we are able to offer is this credit market evidence. So we use that credit market information to uncover the otherwise opaque credit allocation in China. And we document, numerically quantify the magnitude of that segmentation post-2018 and its real impact. For the asset pricing literature, we basically contribute to the information content of the credit spreads. We find that in China, it's very unique that it's not only credit quality that matters, the extent of the government support also matters. And that how it matters actually varies over time. And the last literature is with respect to the government support and the credit spreads. So Darryl and his co-author actually has a very nice paper, actually was presented at ABFER's conference. They look at government support with respect to bailout probability and the credit pricing of banks pre-2008 and post-2008. What we find here is the government support and credit spreads in China. So these are our relation to the literature. Our paper is also related to this growing literature on China's credit markets. So let me now go through all the details. The key message is that as of today, we can still put all this literature kind of in one page, but hopefully over the next few years, over the next 5-10 years, there is emerging activities in the study of China's credit market. So this page probably will expand much further. So now let me get to the detail of our paper. So I'm gonna spend a few minutes on this table because this is one of our most important findings. So we're gonna pick issuer I in quarter T. We measure its credit spreads by the yield of that issuer in quarter T's yield to maturity, and we benchmark it against CDB, because in China, the China Development Bank's benchmark yield is a better benchmark relative to the CGB, the China government bond. So the credit spread is measured as the yield for issuer I at quarter T benchmarked against a CDB bond of the same maturity. And we regressed it on this non-SOE dummy, which is one, if this issuer is a non-SOE. In China, there is no ambiguity. Either you're non-SOE or SOE. So we use this non-SOE dummy to separate non-SOEs against SOEs. And that regression is a panel regression run quarterly. So effectively, this coefficient B, which is reported here, picks up the SOE premium. You can see that coefficient is across different phases. It's always positive, meaning that non-SOEs are paying a higher yield. So their financing cost is higher. How much higher? For example, during phase one, it's about 20 basis points higher compared to SOE companies. And given that the ratings are different, there are other controls for the firm, so we control for all the variables. So effectively, this 20 basis point is telling you that two companies, they otherwise are identical. The only difference is one company is a non-SOE, the other company is an SOE. Their financing cost is 20, the non-SOE's financing cost is 20 basis point more. So in fixed income market, 20 basis point, it's a pretty large number. And the number in the parentheses, squared brackets, these are t-stats of that test. So you can see it's also statistically significant. We further separate the timeline into phase 1 to 3, and the dates are, I will be more specific in the next page. So these dates are related to, as I said, there are two important dates in China, in the development of the China's credit market. On this page, you also see that we look at this SOE premium not only for listed firms, but also for unlisted firms. But overall, we're going to focus mostly on this sample of listed firms. So to the extent that we are looking at this SOE premium, we're looking at this inefficiency or inefficiency of a credit allocation, we are actually focusing on the listed firms, which happen to be the largest, most important firms, non-SOE as well as SOEs in China's economy. So we are not picking smaller non-SOE firms. So last piece, as you can see, from phase 1 to phase 2 to phase 3, there is basically an explosion. So let me actually show this result more explicitly by looking at this picture. Okay? So again, color coding, you have 3 phases. The first period is when there is no default. So you can see the first phase ends in the first quarter of 2014. So that was prior to the first default in China. And on average, you can see this is the difference in credit spreads. On average, it's about 20 basis points. And the shaded area are the 95 confidence intervals. So you can see over time, until the second quarter of 2018, there is a huge explosion on this SOE premium. So if you look at the timeline on the right, the time leading to that important date of 2018 was the new regulations on asset management. Prior to that was a sequence of deleveraging campaigns. So this is the first important finding in our paper, is to quantify what is the overall size of the SOE premium, and also what's the time variation. You can see because of the credit tightening, this SOE premium could explode rather quickly to a level of 100 basis points. These are huge numbers in a fixed income market. And also realizing this effect, realizing this unintended consequence, or the struggling of the non-SOEs, governments actually repeatedly give speech, give policies to reassure the private sector that we care about the private sector. But you can see that SOE premium remain heightened at a high level for a pretty long duration. So these 3 periods are going to be, and the explosion of the SOE are going to be the center of our focus later. So behind, as I kind of allude to it, behind this, there are a sequence of credit tightening. So what's the explanation for that explosion? So here we look at two possible explanations. One is clearly because of credit tightening, SOEs are more vulnerable than non-SOEs are more vulnerable than SOEs. As a result, like a run on non-SOEs, investors basically abandon non-SOEs and seek safety in SOE bonds. Another explanation is credit quality. People might say because of overborrowing or overextending, non-SOEs are just weaker and they cannot, they are ill prepared for that credit contraction. So for this, we have two measures. One is the default measure, which we use Merton's model. So given the interest of time, let me skip the details and just say DM is our measure of default. Lower the credit quality, more likely to default. These are the issuers with higher default measure. And another measure is the proxy for government support. So we actually create a measure from ground up that proxies how much government support there is for each of the issuers in our sample. So let me skip a few slides. Given the interest of time, let me just give you the result. So this is the same set of regression, except that we put DN, which is the default measure, and the government holdings into that regression. We want to use that to explain the SOE premium. Or in other words, can these measures drive out these SOE premiums? So as you see from the prior table, over this three phase, you have non-SOE premium about 20 basis points for the first two phases, and then exploded to 100 basis points. Now let me add default measure into. So you look at the yellow boxes, which is after controlling for default measure. You find that phase one, no change, still remain 20 basis points. In phase two, the SOE premium actually deepens. Why? Because default measure or the non-SOEs are actually healthier with lower default measure relative to their SOE counterpart. In a way, in the second phase, as you remember, during the second phase, that's when default happens. That's when the default happens. So you put in the default measure, you see that it becomes significantly important in explaining the cross-sectional variation in credit spreads. At the same time, it actually deepens the SOE premium. And the last piece, what if we add government holdings? And that's when things become more interesting. You can see phase one, phase two, this government holdings measure has no teeth. It cannot explain the cross-sectional variation. But in the last phase, as I said, last phase is when SOE, non-SOE were under stress. SOEs were safer because they have government support. So here you can see government holdings become a more important explanatory variable. Higher the government holding, lower the credit spreads. Moreover, you can see that this SOE premium actually goes away. So in a way, this is showing that when we find this explosive SOE premium 100 basis point shrinks if you allow government holdings as an explanatory variable to explain the cross-sectional variation in government in credit spreads. So let me just show you this picture in terms of credit spreads, the information content of credit spreads. So here, what we find is that if you use default measure to explain the credit spreads, here we are looking at the non-SOE samples and the SOE samples separately. And you find that gradually, as this is the time when default started to happen, gradually both become important. But what's interesting is that post this 2018 data point, during phase three, price discovery with respect to credit quality becomes more important for non-SOEs, but remain more or less the same for SOEs. But what's interesting is that government holdings, as you move on to the phase 3, both SOE and non-SOE react to that government holdings measure. Okay? But if you compare the incremental R-square of that regression, you find that now the SOEs actually are more sensitive to the government support. So in a way, you look at information content of these credit spreads, there is a digression, with SOEs becoming more sensitive to government holdings, with non-SOEs become more sensitive to the credit quality. So that's our finding of information content of credit spreads. So let me give you one last result and then I will close. How does that affect, what is the real impact of that credit market segmentation, of that explosive SOE premium? So here on the left-hand side, we plot the quarterly ROAs, return on assets for SOEs and non-SOEs. You can see non-SOEs are always on top of the SOEs prior to phase 3. Post phase 3, you can see a collapse of the non-SOEs or the blue lines. And you test this difference using, again, a quarterly panel regression, picking this coefficient B. You can see that after controlling for equity size and other fixed effects, you can see that during phase 1 and phase 2, non-SOEs are always more efficient in terms of ROA relative to SOEs. How much more efficient? About 56 basis points per quarter and about 2% per year. But what's interesting is that in phase 3, that advantage shrank to about 13 basis points. It's no longer significant. So here is a finding that in addition to that segmentation in pricing, or maybe a result of that, there is a real consequence on the efficiency of the SOE and non-SOEs. So that's overall, that's what we find. Let me conclude. So our paper is the first comprehensive study on price discovery of China's credit market with respect to credit quality. We focus on the credit market allocation between SOE and the non-SOEs. We are the first to quantify the extent of that misallocation and also its time variation and its driver. So in understanding the driver of the SOE premium, we find that there is an emergence of government support in credit pricing in China post-2018. Examining the real impact of this allocation inefficiency, we show that non-SOEs in China actually are losing their advantage of SOEs in terms of their profitability as well as their fundamental strength. So overall, our paper finds it's kind of a paradoxical finding that we find improved price efficiency, but also worsening segmentation as government support comes into the market, emerges as an important factor in credit pricing. Thank you.
Thank you, Jun. Our discussion is Professor Zhiguo from U of Chicago booth and BFI. Zhiguo, the floor is yours, please.
I want to be short, and this topic doesn't need any explanation. So I enjoy reading it. This is the results in one chart or slide. And to be honest, I first read the table. Nowadays, I start to, kind of like always read the table first for some topic like that I'm familiar with. So this table just tells you everything that they're doing, which is great. So you have a phase 1. Phase 1 basically is 2 dates that Jun was mentioning. One is that about the first default, and then the second here is after the 2 and 3. That's the real part that they're emphasizing. That's the new asset management regulation coming up. Okay, All right, so you can see that what's interesting that after the phase 2, right, after the default, then people care about the DM, default to default measure. It's basically merchant type of stuff. And then you see the government holdings start to showing up in the phase 3. That's after the new asset regulation. So there's a story that in their mind to putting all these things together, which I think this part is new, and I enjoy the presentation or results in a very coherent and compact way. All right. So one thing that when I read it, I immediately get attention is that sometimes they emphasize this R square, sometimes they didn't. There's one important R square they didn't emphasize is down here. So the way that they are presenting to, at least the paper was basically saying, look, in previously, even they just labeling it. Think about it, it's like a non-SOE. So one label is good enough to just as a block. Even if you put it in very nuanced measure, let's say DM is default measure or government holdings, really people don't care about it, right? So phase 2, then they start to seeing, oh, DM is important, and let's figure out what's going on. And then in phase 3, you see that, wow, all of a sudden that whether you are labeling of the SOE or non-SOE start to not matter. What really matters is the government holding. By the way, they did a lot of work in this measuring the government holding. What I want to emphasize is that, yes, it is true that the government holding are able to kill the fixed effect of non-SOE or SOE, but the improvement of R square is very teeny. Okay, I think it's an interesting thing that the audience, if you're a PhD student or young faculty members, you should start to explore that. For many potential reasons, one is a crude measure of government holdings. So Michael is here, and I'm a colleague of Shanghai. They have much better data in getting that right. But I believe that Jun and they get the ballpark of the holdings, so that should be there. The second thing probably is more interesting, and if you guys, somebody has the data, you should explore. Okay, so often the time when I talk to the traders or the practitioners in China, in Chinese bond market, they not only look at who is the owner, but also looking at who give them the loans. And it's perfect from a finance audience, right? The very important thing that I'm explaining to my MBA students is tell them that actually debt holders are also owners. Debt holders, enjoy part of the cash flow. So as a result, if they're both owners, and when you get into the trouble, obviously, the big 5 banks probably will play some role. So you might want to get some information on these on the bank side, and that might help you to increase the R square even further. So that's basically, this is the slide. This is the only slides that I'm really telling you the paper is about. The rest of the slides are really just telling you that in my mind, how do I put all these facts together? This is a slide just explaining some points when I was reading your paper. First one is not that important, but I would like to point that out. Jun was using the word of market segmentation. I am not exactly sure when I read it, just because from the academia as well as from the practitioner perspective, segmentation typically means from the perspective of investors. And for the SOE, non-SOE, they have the same investors, same regulators, just that people feel that the non-SOEs are not that creditworthy. Okay. The second point that I learned from reading the paper, I sort of knew, but it's quite important for the future corporate bonds researchers in China, is that it is very common for corporate bonds in China to carry embedded options. That's actually more than what I thought. So, and Jun was mentioned it's like 70%. So I will show you some slide. Next slide is on this, what's the percentage of bonds that have embedded options, which may matter for your study, okay? For most of the studies, it will matter just because when you do this credit and liquidity spreads, as you follow the US way, then it's much harder than the US study, because they just get rid of all these bonds with options. Some studies not. So I have a paper where we use the dual listed bonds. So you just take the bonds in two different markets and take a difference, then that should not matter. But I feel like it is an important fact that I want to use this opportunity to mention this to you. All right. And what's also third part is interesting is that they have a sample where they show that the non-SOEs, so there's some non-listed SOEs, they also have government holdings. I do not know how do they accumulate it, but perhaps I was checking the numbers, like 5% to 10%, which is kind of interesting. And they do show that those things matter. Okay, those things matter. Okay, so that's interesting facts. I quickly just tell you several facts about the embedded options. Look at these 4 different bonds that typically we refer to. So this is a private placements, corporate bonds, commercial papers. This is a very short part enterprise. Only the commercial papers and private placement notes does not have any, a big portion of it does not have any these embedded options. Those things are concerning if you want to do more research on that. Just be careful on that. Okay, good. So now I'm getting to really just try to tell you that how do I think about the effects, and I would like to give a slightly different alternative. I would not say it's a completely different, but it's a slightly different alternative views that I would put a little bit of blame as well onto the private sector. Okay, so here's a background that you probably, if you follow the China's in the last decade of growth on this so-called social finance, basically it's a 社会融资. That's the increment. So that's the 增量. That's the change. That just to tell you that how does the China finance the GDP? Okay. So you see that 2015, 2016, and you see the big drop over here. This is the non-standard shadow financing, basically including the entrusted undiscounted bank acceptance. They don't include the wealth management products, because wealth management products have a lot of double counting. So this is just basically from the social finance. So you see the big drop. That's the new regulation. That's the regulation on asset management. I don't need to explain that. And you see that in 2018, there's a corporate loan go up. There's a long, there's a short, and here is increase on the bond. So basically, it's the idea that they want to push cracking down the shadow side, push to the bright side. Okay, so that's a background. Here is another picture I want to show you. It's a revenue YOY growth. So I take the listed corporation, I list the company sample. So I put it here. Overall is SOE, the other is a private. Later on, I always call it non-SOE, just because I think it's sometimes private non-SOE is slightly different. But this is what I took is basically non-SOE, treated that as a non-SOE. What you see is that even in 2017, that the private company or non-SOE companies really grow like really large. So those are the percentage growth. This itself is just already growth. Okay, so this showing that it's going up. It's like the change of speed. It's acceleration. Okay, and then in 2018 they dropped quite a bit, and that's basically what we are now. All right. When you get into the finance side, you see something very concerning actually. So if you are looking at the SOEs, for SOEs, you see that they're investing cash flow. So that's how much they invest. And the financing cash flow is really low. So you think about it like a cash flow statement, right? There are 3 parts: operating cash flow, financing cash flow, investing cash flow. When you're adding them up, it has to be 0. So I'm just taking out the operating cash flow, basically. So you see that basically the whatever I do not show here is the operating cash flow here. So SOEs basically that after, especially 2016, you see that here, they shrunk their their financing quite a bit, and investing cash flow. It's just a kind of a steady growth. Okay. For non-SOEs, we see very different picture. Okay. So here is they invest very, very aggressively. As a result, in part of that, the financing is basically there are financed quite a bit. So that's basically financing cash flow. You see that here they only use a very small part of it from their operation. So they're expanding. Okay. That difference really you see it very clearly in 2016. So what happened in 2016? In 2016, SOE is deleveraging very heavily. And SOE is in a way that this is why SOE is, they listen to Beijing and they're supposed to, right? This is so there's a lot of you can think about them externality or these things that when Beijing sees that we should try to reduce the leverage, they listen to it and we indeed follow it. At that time, if you can see this picture, you see that the non-SOEs pick up. All right. So this is also this picking up that from some of the numbers I'm showing you, that you will realize that in 2017 and 18, 2 years later, the trouble that the non-SOEs are facing a lot of times is because of the aggressive financing of the 2016, and they are using very short-term debt. So I will show you 2 slides and try to convince you that this is part of the story is like this. So what I'm doing here, okay, what I'm doing here is I'm taking the non-SOEs, they are private firms, okay, and I'm taking the defaulted sample. So these are the defaulted sample. Then I'm trying to see that before they're defaulting in the previous 3 years, what really happened. For instance, in here 2016, that's basically I'm taking the firms that are defaulted in 2016 and looking back 3 years. In 2017, I do the same thing. So you can see here for these firms, their cash, even though they defaulted, their cash is pretty steady. Okay, and this is the short-term rigid data is also very steady. However, if you're looking at the 2018, 2019, things give you a very different pattern. It seems like a cash really dropped quite a bit for the sample that you are defaulted in 2018. For the sample you're defaulted in 2019, same idea. You can see the cash dropped quite dramatically. And from 16 to 17, they're shortened these debts like commercial papers within like 3 months or 8 months. This is like the commercial paper Duanrong, then increase. And as a result, you have this a liquidity issue. Okay, so
Zhiguo, there are a few people who want to ask questions. So leave us some time for their questions too.
Oh, sure. Good. So then you get to, so let me try to making sure the time. Okay, good. This graph points to the insolvency issue that you probably think about. Okay, is this because of the insolvency? From the data that I'm getting at, this is exactly the same thing I'm doing. At the 2016, I'm taking the defaulted sample, looking back. At the 2018, at 2019, I'm doing. One thing that pops out very clearly is that if you just look at the fundamental that they are defaulted, 2018, 2019, they look better than the whatever, or those are the firms that are defaulted in 16 and 17. Okay, so why I'm all doing this is that I think that first of all, that it seems like you want to establish the causality of a finance to real, because the way that you're explaining to us that it's the asset management crept, asset management started, and then the spread go up, therefore you see the ROA goes down. That's very hard to really say that this is because of that. And I'm proposing something saying that maybe you could look at these like a financing side of liquidity issues, and hopefully you can tell a little bit about it. So here is just an elaboration that of what I'm saying. Okay, so in your mind is a credit spread up in non-SOEs, therefore leads to the worst performance in non-SOEs. That's to me, that's a pretty strong statement. And we know there's a lot of stuff going on in the 2018, 2019. Okay, what data reveals that the SOEs deleverage quite a bit in 2016, non-SOEs pick up the slack. If you look at the credit growth, actually is very clear on the 2016. And the economic slowdown in 2018 showed up. Then you have these two effects. Is that one is that because they have a high beta, so they hit harder. The other is that they are very, very much sensitive to the financing financing issue. I think there are a lot of things that you can dig up to try to say a little bit about how much is coming from that sample, how much is coming from that sample. And I will stop here with these two things. One is that reform is not easy, that as the Jun was talking about, it's basically that you see that there's an implicit guarantee somehow that Beijing cannot get rid of it or cannot get rid of 100%. Then you have a market force. Then there's a good market force, you have a bad market force, who knows? Second point is that I would like to see more research from the Chinese bond market. Okay, I'm done.
Thank you, Zhiguo. You help us to get into many other important areas and angles to look at. I would like to let Michael ask the question. Michael has a question for you, and I think he has to leave soon. So Michael, Song, are you there?
Yes, thanks a lot.
Yes, will you please?
Yes, thanks a lot, Jun, for the great presentation. There's tremendous amount of interest in, understanding how recent default cases affect China's financial market. And this is the first time I see, things put together in a coherent way. In particular, the interesting thing is you sort of distinguish kind of, I'm probably a bit exaggerating, fake SOEs and true SOEs. And, this is the first time I see this distinction. But my question is more or less related to the last point, raised by Zhiguo. So this, how do we think of the real effects? So one thing I think which is much harder to nail is how those credit allocations are responding to credit spreads. One way to think about it is the elasticity. So in an extreme case, if say all SOEs or non-SOEs or those fake SOEs, their lending is completely inelastic to those pricing. Then what we see in the responses of credit spreading to whatever put on the right hand side will have zero effect on efficiency of capital allocation across different types of firms. So that's an extreme case. So what is unclear to me is is there a way to estimate the elasticity, say by looking at capital allocation before and after, or between phase 1 and phase 2 and phase 3? I think this is something helps to think of the real effects. Thanks.
Any answer?
Hey, Michael, and Zhiguo, thanks for the excellent discussion. And Michael, that's a really good question. Kind of similar, to respond to Zhiguo's comment as well. We are not saying credit spread or credit market is the cause for this inefficiency. The reason why we are using credit market information is because that's the most transparent place where we can see the credit allocation. So in a way, the SOE premium as captured in our paper is a reaction or phenomenon of the overall credit market condition. So I think it not only say bank loans sector, but also the shadow banking. I think probably the credit spread explosion captured by our paper is very much related to the shadow banking activity as well. So all of this is put together. That's what's giving the real economic impact result. So that's kind of in agreement to your comments. Yeah, it's not a credit market alone. But so thinking in terms of how to gauge the real impact, that's really a much bigger topic with probably access to more data. That with that kind of with credit market information alone probably would not help us establish that causality. It would be very difficult.
Would you mind to comment on, maybe you also see this from Daryl Duffy. He said, I have the same question as Wei Chen regarding default risk, default event risk versus recovery risk, the latter of which is perhaps higher for non-SOEs. Do you have any comment on that, response to that? And what's the implication of that to your results? Yeah.
I think we don't yet have the luxury to differentiate credit spreads with respect to recovery versus probability of default. With more data available, maybe we could do more. But as a first try, what we did was just using Merton's model to get focus more on the probability of default rather than the recovery side.
For some of us who are not so familiar with the Chinese regulatory change, can you and Zhiguo quickly comment, and Jicheng and Zhang too, quickly comment on really what's the significance of this asset management regulation change? I mean, what should we, you have the new regulations on asset management. Can you just comment a little bit on this? Because my feeling is that it impacts on a lot of things, and Zhiguo has pointed out too. And also there's also a change in the environment. So for many of us who may not be as familiar and want to get into the research, please help us a bit.
Zhiguo, you want to?
Zhiguo, you want to go first?
Okay. I will keep short. So this is it's not one thing I want to add is it's really, I don't think it's a very sharp, like come out of a surprise type of regulatory tightening, because the first time that I knew it's very official announcement, it's the second, like November 2017. It is quite a formal announcement saying that we're going to do it. And then 18 Q2 has some even more clear, explicit way of doing it. Basically, what they are doing is try to cut the so-called channel business. In Chinese, it's called 通道业务. After 14, 15, 16, I think it's 2015, 16 is a kind of at the peak, where basically that you have a channel where people you can attract like people like my parents to buy these wealth management, and then get through all the way through different layers of leverage, etc. Gets into either trust or these like asset management plans, and it gets to the stock market, either stock market or the interbank market, which is the bond market. And this is a super complicated. I remember that Wu Xiaoling has a pretty nice, report on that. So this is basically saying that, look, starting from now, you have to have this so-called penetration management, so that I need to know these money where they're coming from, and impose some regulatory requirement on this leverage, for instance, at the most two layer, etc. And that immediately just make the financing side evaporate. And I truly believe that that's exactly where initially in 2016, 16, 17 in my story, that they are feeding these non-standard financing. And then all of a sudden it gets evaporated. And it's, in my mind, it was just in a bad timing. Then you have a trade war, all these things. It's just that people's confidence goes down. All these things is showing up. And the Jeuck might have a different take on seeing what's going on in Shanghai. But when I talk to the traders in Beijing, seems to be that it is a combination of different forces.
Any comment from from Juntang and Zhigang on this question? And also, like, I want to open up, like, if other panelists have comments.
So I just want to take the opportunity to respond to Zhiguo's a few other comments from Zhiguo's discussion. First, the embedded option, we actually saw it in our data. We did several revisions to accommodate or to deal with this embedded option. So in the end, we use a dummy to separate bonds with embedded option and without. So that was kind of a rough.
Yes, I saw that. I saw that.
But we are definitely aware of that. Second, in addition to this government policy that triggers that explosion of credit spreads, another very well circulated, well-known argument is exactly like your discussion, is that through the boom, these non-SOEs are really expanding, they're ill prepared. That's why we have the murder measure. Our credit, the default measure is exactly to address that. Maybe it's a two course of a measure to capture that feature. But we have, throughout the process, we also have a kitchen sink approach. We basically throw everything on the firm's balance sheet to explain the cross-sectional variation in credit spreads. And interestingly, the Merton's measure actually works out the best. Intuitively, that measure takes leverage, takes asset growth, takes equity volatility for an issuer combined together. And interestingly, that measure is actually the best in terms of explaining the credit spreads. And as you pointed out, the best actually has very limited R-squared. So the explanatory variable actually is very limited compared to what we know in the US. So yeah, but thanks for pointing these out.
Other Jiang and other panelists, any further comments before we close?
Can I ask one more? Oh, sorry.
Yeah,
go
sure.
ahead.
Please go ahead.
And I also think there are some questions in the Q&A. I think it's worthwhile just whether.
Yes, please. But I somehow I don't see.
Do you guys see the Q&A?
Okay, now I see that. Sorry. Yes, let me thank you very much, Zhiguo. I overlooked this one. Let me go from Bo Li mentioned, can the authors explore the firms that were closely bailed out through the specific cases? Maybe I'll switch to something else. Okay, let me start. Gunter DeVay asked a question. Have SOEs become more productive?
Well, if you remember the last plot here, it's kind of a downward trend. So it's let me maybe so you want to respond to that question? It's a relative statement, relative to the non-SOEs, yes. But overall, not really, not according to the plot I see.
They're just dropping slower.
Yes.
It's kind of. I always thought that it's maybe I was wrong. I would have wished that I'm being confirmed to be wrong, which is that I thought that SOEs are in a more low beta business usually. Okay. Now, even after you're controlling the industry, I wish that that's the first thing you could do, clearly. But I worry that even if after you're controlling the industry, because of their very fine positioning of the industry, this will still might give them some advantage in terms of the securing the the supplier, the the borrower, all these things. So this is I always thought that the SOE itself is just to have a lower beta. Anytime you have a shock, naturally economic fundamental is less sensitive to these external shocks.
Okay, there's a related question. Is the deteriorating profitability of non-SOEs the consequence of the cause of the higher credit spread?
Well, that's the part. The causality is very difficult for us to establish. As I said, the credit spreads, the explosiveness of the credit spreads is more of a phenomenon, a reflection of the overall economic condition, not just the market alone. Because the market, if you look at China's credit financing, bank loans remains to be the dominant force. So it cannot be driven by credit market alone. But Zhiguo's comment is we should study more. The SOE is being the lower beta sector, our limitation of our industry control. That might be something we want to explore more. So yeah, thanks.
There's a clarification question by Hugh Thomas. Is your efficient ROA measure before or after deduction of interest? Is that for clarification? That was a while ago. Sorry, I missed that.
So you want to answer that question? How do we measure of our ROA?
Is your efficiency ROA measure before or after deduction of interest?
That's the net asset. Net profit divided by the asset.
So deduction of interest, I guess. Yeah.
Okay. Yeah. Then let me see if there are Ray Chan's question. Daryl has mentioned it and we have raised it. One more question is really why would the local government do not provide government support to non-SOEs?
Could you say that again?
Laura Wu asked the question, if the local GDP growth rate is the concern of local governments, they should care enough on the non-SOEs as well. So why do they not provide support to the non-SOEs?
I actually think this is a very good question.
Yeah.
I had a discussion with Michael. At some point, we were thinking that it is very hard a lot of times that even with very successful private companies, if you dig deeper, right, Michael, they dig deeper. A lot of times you see something behind their ownership structure. Not only saying that they care about the local economics, but also they also care about something else, which means that in China, it's the private versus the SOE, non-SOE, it's extremely blurred. Michael, you want to add something?
Yeah, sure. So I think that's related to what I mentioned before, fake SOEs. So in the past, a lot of private businesses actually tried very hard to get connected to the state. So endogenously, some SOEs are actually labeled as private firms are actually labeled as state-owned enterprises. So in a way, if you can establish this connection, then you become part of the club. So it's not like exogenously, if you set up your private firm, then it has to be private all the way. But
so how and to what extent? So in a way, like the government holdings and so on, is assume that the investors they actually know and so on and so forth. To what extent is this very endogenous? It's not about the type of firm, but it's not about SOE, non-SOE, but it's really about the buyers know what they are getting into.
Yeah, Chantai, Chuan, and I have a paper actually on that. So you will see that paper, I think, in August. We're going to show you the expansion of this endogenous, semi-state, semi-private sector, and how it affects, marginal product capital.
Let me respond to that question as well. That's a really interesting question. So what we are measuring are the credit market pricing. So from credit market investors' point of view, clearly they don't think the local governments will be saving their local non-SOEs. I mean, that's kind of what's reflected in the credit market pricing. But as Zhiguo said, maybe it's more about the connection rather than the local economy that they care about.
One more thing is like this regulatory change is really trying to make the investors more careful, etc., etc. And to what extent has it really changed the investors' combination on the market?
You mean their perceived risk? Or so Jun showed that indeed investors become more careful, which is a great thing.
Yes, they have become more careful, but is it because of the more careful people stay and the non-careful people leave, or what? That's my question about the combination.
Oh.
So what, like, I do want to have a good, and do want people I do not want to over-regulate, but I want the people who really care for the return to the money be smart in the investment.
But the regulation was not even focused on the credit market. It was for the wealth management product. It was in the asset management sector. So the intent of the regulation was to clean up either it's not just one regulation, it's a sequence of deleveraging. And the objective was to clean up the shadow banking sector, was to clean up the wealth management product, the channel business. But as a result, it feeds back to the credit market. So the original intent of the regulation was not to push the credit market investor to be more careful. But the credit market investor react to that regulation, and then they basically en masse, they abandoned the non-SOEs. For many asset managers we talked to, they said we only invest on SOEs. We don't touch the non-SOE funds anymore.
Okay, there's a lot
kind of
more.
an unintended consequence of a sequence of regulation.
Well, any other comments and questions? So Michael, you.
Let me have a quick question about the real effect again. So I think you compared SOE versus non-SOE, but you didn't show us actually if you sort of differentiate SOEs by their government holding. Say that
we have a table on that as well. The results are very similar to the label.
I see. So the reason why I asked the question is, think about who will be greatly affected. Is those actually, using my own language, fake SOEs.
I see.
Mm-hmm.
So if you find ROA, ROE dropped most dramatically among those fake SOEs, that will be an evidence. But it seems that they more or less similar to SOEs.
By the way, Michael, would there be fake non-SOEs?
Well, so those that's probably related to our work. Those private firms, they
Right.
started as a private firm, and then later on, in order to get all those advantages, they try to get connected to state, and there's a lot of anecdotes on that. Yeah.
Okay, and yeah, well, I think that the really important bottom line is how efficient, how effective the capital market, the capital allocation is. And then I thank everyone. This is Junpeng and Zhegang, thank you for the wonderful paper, and Zhiguo, thank you for the very stimulating discussion, and all the audience and panelists and so on. Thank you for your questions. I think, like Zhiguo pointed out, there is a lot of things in this about the cash flows and the bankruptcies and so on. So I'm very happy that next round in April, our paper is Going Bankrupt in China. The presenter would be Professor Jacopo Ponticelli from Northwestern, and also the paper is joined with Bo Li. Zhiguo, do you have anything to add before we run up?
Really no. Thanks everybody for coming. I saw the the number of audience is pretty amazing. So Jun, it's because of you.
Oh,
Thank you. All right. That concludes the session.